And welcome to this update with SKAGEN Focus. I'm presenting here today, as per usual, with David Harris, my colleague who also runs the fund with me. So, looking at this picture, it's interesting. Everywhere you turn on your radio, you turn on your TV, you look in your local financial news or global financial news, you'll find the word recession. Everybody is very much interested in discussing the potential doom and gloom that's out there and that's currently sort of coloring financial markets. In this presentation, we'll take a look at, is it really that dark out there, or are there any bright spots that we as equity investors and in particular value equity investors can focus on and find out there? And indeed, we think there are many bright spots if you're willing to look out 2 to 3 year horizon, which of course is the investment horizon for SKAGEN Focus. So we're going to take a look at that, as well as, of course, the usual investment case descriptions. We have a number of new holdings in the fund. We're going to go through 4 of those in this presentation, as well as look at the current portfolio construction situation. So just to remind you what we are up to in SKAGEN Focus, you know we're focusing exclusively on finding very cheap equities that trade with a substantial discount to fair value. In our case, it's a 50% upside we need to see in 2 to 3 years' time without taking any growth assumptions into account. So that's a 50% upside on steady state or historically confirmed earnings power. And it's interesting now with this correction in equity markets, you've seen that the investment universe for us as price-driven value investors has really opened up. And we can now access new sectors and new parts of the equity market, which hasn't really been available for us because the price tag has been too high. And then I'm speaking, for instance, about the consumer related names, apparel names, high quality brands out there trading at very low multiples. We also have technology names, which we have accumulated a few now, which is a new situation for the fund, which also we've seen select pockets of value showing up in the technology sector, which we also are taking advantage of, we think, in this situation. So all in, a very interesting environment for us as price-driven, value-focused contrarian investors. So looking at this with being contrarian, you've seen this slide before from us, but the quote here is actually new. And you know, when we are contrarian, we think we need to go or swim against the tide to create substantial value over time for our unit holders. This particular quote, it's we apologize for the long quote, but it's a good quote from Howard Marks, the very distinguished value investor, which we follow closely, of course. And he talks about the investment herd. And I thought this was interesting. And the investment herd these days, this is not only retail or institutional investors, it's also the machines, the robots, the quants, the computers running trillions of dollars basically out there in financial market, driving stocks up and down, intra-spread, intraday, intra-month. And this creates, I think, even more interesting opportunities for those who are willing and have the guts to go against the tide like ourselves. So it's essentially we against the robots, if you will, which sounds a little bit harsh, but that's a little bit what it's like to be a contrarian investor. So I think in the long run, potentially a very lucrative exercise for us as value and contrarian investors. So looking at the macro environment and just what are these dark clouds hanging out there? What are people focusing on currently? Well, currently there's a lot of focus on this chart, of course, which is the reality. It's already upon us, the consumer weakness out there. This is the consumer confidence indicator across many regions, where you see the standard deviation from the mean here is as bad as it was in the global financial crisis in 2008, 2009. This is an extreme reading. It is due to, of course, electricity prices is sky high, crude prices sky high. You have food inflation. This is really a bad situation for consumer spending, of course. But the message here is that this is not a new signal or information for the equity markets or for financial markets in general. This has been building up for months. And we would argue this is already priced in perhaps not entirely, but very much so, into consumer-related names that are down maybe 50, 60, or even 80% year to date only. So this is the situation currently, and I think our clear message, this is partly discounted in equity market, which makes it actually a pretty bright spot. So we need to look forward, of course, what is the next developments here. Another dark cloud is that's hanging over the markets, and especially Europe industrials, is gas.
Yes, I think that nobody has missed the energy crisis that has been unfolding in Europe throughout the summer, and the gas prices that has risen dramatically. And this is maybe somewhat complicated charts that you see below here, but it tries to illustrate the magnitude of change and the source of further uncertainty that we have witnessed throughout the summer here. So if you look at the left chart, you see the red and orange line, it's the gas price, and you see the sudden spike there, of course, in June. And before that, you have the expectations of the futures curve for gas prices in Europe. It's the blue line, and you see the significant change following June in terms of expectations. And this has, of course, created massive uncertainty. This has been an overhang on European equities as the market has been trying to digest this uncertainty and the potential effects of it and the likelihood of different scenarios. And thinking about scenarios, you have it on the right side. It's the Europe's natural gas storage on the different types of scenarios with regards to supply coming from Russia, primarily from Nord Stream 1. So this has been a massive overhang on the market, and which is very well reflected. And the market has not been merciful. Even positions like Wienerberger, which we have highlighted before, it's a position in the fund. It's an Austrian brick producer and infrastructure solution provider that went into the year fully hedged when it comes to gas prices for this year. But anyway, it has still been hammered as people are fearing different scenarios with a potential gas rationing, force majeure type of situations, which would make hedges and so on invalid. So enormous uncertainty in the short term, but of course, a lot of very attractive opportunities for active investors such as ourselves, which we'll get back to soon.
And of course, we've been talking about the risks and the risk for higher interest rates, the risk for inflationary pressures coming into financial markets. And this has, of course, been the actual case. This was building up already in the COVID sort of return of economies, the inflationary pressures, but then was, of course, strengthened by the Russia-Ukraine war situation, which created a huge commodity inflation on top of everything else. So now we're sitting in an environment where you had this chart shows the US CPI year over year as well as the PPI year over year. But it's interesting that these levels of about 8% year over year change in the CPI is soon going to meet some very difficult comps. And that means, is it possible that these measures can rise another 8% on an already 8% increased number 1 year ago? That is now the question. Crude has come down, commodities has come down. We're seeing supply chain get a little bit better. You're seeing central banks now not yet are acknowledging the economical weakness, which we will no doubt see in the next few quarters. But they will probably acknowledge that at some point, probably within the next 6 months or so, which means that we need to think about a peak inflation narrative scenario combined with a milder recession. Even a worse scenario is thinkable, of course. But the sort of derivative, the change here is on the downside. You're seeing that these new observations in the inflation numbers in the US is actually lower than the previous one when you talk about rate of change. And it's always the rate of change that drives market prices. So this is potentially a spot that could be on the brighter side as we move into the second half of this year and early next year, we think.
We have certainly seen a correction in especially the US market, and especially among tech-related names, which are coming from valuation levels which have been extremely high. And this has, of course, created a lot of opportunities for us. As for those of you who have followed us for a while know that we have struggled with finding exposure, especially towards US tech-related names. But this has opened up interesting opportunities, which we'll cover soon. But looking at US valuations from a cyclically adjusted point of view, using a Shiller PE ratio, we still see that even though this correction might seem to be of a very dramatic nature, we're still quite far above the mean from a long-term perspective, which also explains why value-driven investors such as ourselves are looking elsewhere where we see even deeper value. And now we're thinking primarily in emerging markets, in Korea and Mexico, where we have found a lot of interesting opportunities, which you see in the fund, but also Japan. Also among industrial metals, we see very interesting opportunities. These metals are crucial to enable the green transition that we all hope for. And even though short-term demand might have been weakening, we see no change in supply, which of course we think is quite attractive going forward. So you have copper-related, nickel-related names in the fund, which we think is very attractive for the midterm.
So when you sum it all up, if we have the question, is it all doom and gloom? Well, we think it's not, especially if you're willing to look ahead 2 to 3 years' time, or even further out, of course. But you have a situation where the ultra-low interest rate environment has disappeared, and that is something that will stay for a very long time, in our opinion. That is a very good thing for value assets, since people are getting more interested in near-term earnings power and tangible assets in general, where we, of course, have all our focus finding cheap stocks on current earnings powers or confirmed earning powers. You also see that there's now a more realistic level of valuation on intangible assets, which was the whole reasoning behind these high valuations we saw in the tech space, for instance, in the US last year, was the intangible asset basis being worth a lot of cash. They are worth something, but now I think they're trading at a much more realistic level following this correction. We have to think about a scenario where there's an end to the rate hike cycle. There's a peak inflation narrative perhaps building. This is very interesting. There could be start of a new investment cycle where you're going to see, of course, commodities, cyclicals, early cyclicals coming into play. Of course, we are positioned in several commodity producers and industrials now also being hammered by the gas crisis in Europe, trading at probably on average 2 to 3 times its earnings power in the next 2 to 3 years. Insanely cheap. Hasn't been that cheap since the GFC, or the global financial crisis, basically. We're seeing a huge upside in the fund, which we'll get back to currently to our weighted target prices. But we've also the expanded investment universe. Now, if we as value investors can look at several sectors we couldn't look at for a year back because the valuations were too high. Now we're looking at 2 investment cases, which we'll take a look at in a while, which is consumer related and technology related. First, I think we have the value growth picture that we always show you, which is interesting. And you'll see that we had the bounce back from 2020 to early 2022 in value versus growth. Now we have, during the summer, of course, this has retrenched back. But overall, I think there's a very interesting potential for this chart to normalize over time. And value has, of course, been the more superior style over the years, if you're willing to look back at, for instance, to 1975 on average, if you see a trend line. So this is sort of confirming our basic points, with value assets being an interesting place to look at currently. And the new investment cases, well, you probably know these 2 companies, or at least one of them, Levi's, perhaps one of the better known brands globally. It's often up there with Nike or Adidas, 3rd place in general brand consumer minds. The brand value is undisputable in Levi's. We're trying to pinpoint the value of only the brand is quite difficult. but they're the leader, of course, in men's jeans, and they're now leveraging that position into also going into other categories. And the stock was as high, it was listed only in 2019, a lot higher than it's trading right now. Whereas you're up over $30, now trading at, when we bought it this summer, at $16, only 10 times its current earnings power. And this is a growth stock, which we're paying nothing for the growth in Levi's over the next few years. And it's growing their store base. It's interesting, they have a more physical store base rollout, brick and mortar strategy in place rather than online strategy, taking advantage of cheaper commercial contracts currently, and great management team, as well as a very good balance sheet with a huge share repurchase program in place as well. So Levi's is now at 2.5% of the fund. We see more than a 60% upside from our target inception. The other one being a technology name. We mentioned we now have access, we have the right price tags for some technology names. And this Norton LifeLocks was formerly known as Symantec, which you may remember. It's the largest, there's only a few players in this place, cybersecurity for consumers, basically. They have no enterprise business left. They sold it to Broadcom in 2018. And these they have about 80 million users worldwide in cybersecurity and firewall protection schemes. And they have been acquiring a lot of companies. Just recently they acquired Avast, one of the bigger freemium players in the space. And it has a great annuity profile in the revenue stream. And it got down as low as 11 times earnings power in the summer, which is current earnings power, which is, we think, is extremely cheap for an asset with these kind of margins, and this still a very hefty growth profile. We think there's a misunderstanding that they're being threatened by Microsoft, one of the bigger, of course, competitors in the space. We don't think Microsoft's focus is on this particular part of the business. There's a few others, McAfee, etc., but Norton is slowly emerging as one of the absolute dominating companies in the cybersecurity space, and there's a structural, of course, tailwind for cybersecurity. It's really a structural growth story, which again we pay nothing for the growth in Norton. We think at these levels.
So as you know, in SKAGEN Focus, we run a price-driven investment philosophy. We only add positions to the fund if we can buy them at a significant discount to fair value. At least 50% discount we require for a position to qualify into the fund. And there's a broad spectrum in which we can apply our value-based investment philosophy, and we try to diversify in this applications as we identify value. What you see in front of you is a selection of companies from the current portfolio, just to give you some example in order to also see the diversified application in this sense. It's also interesting, Jonas just highlighted both Levi's and Norton. We have recently been able to add positions that are in possession of very attractive assets, which enable what we call economic return value. So the market has not been accurately discounting in their ability to earn above average return on their asset as they're in position of a competitive advantage and a moat around their business model, we think. So looking at the further additions to the fund, maybe less known brands compared to the ones Jonas just spoke about, but that has been enabled for us to enter due to the correction and uncertainties that we have seen in Europe. And these are Viscofan and Compo Group. Viscofan is maybe less known to most of you, but I'm sure that most of you have come in contact with their products. Viscofan is a global leader in artificial sausage casings, so the skin around the sausage. They're twice as big as their closest peer, and they're very well positioned to benefit from the underlying food consumption trend, and especially from the substitution of natural casings into artificial casings, which also come at a better cost advantage for customers, but also in terms of certifying that the quality is correct in a large-scale production. We have been able to enter a position here in the fund without paying for growth. Viscofund recently came with a new strategic plan where they certainly have quite attractive growth ambitions, which we believe in, but we're not paying for them. This is a company that has a very good track record, well-established management team, and a strong balance sheet, and generates healthy amounts of free cash flow generation. It's been on our radar for quite some time, but it never traded in the price range which it did now. So we took advantage of the situation and added it to the fund. It's been a quite strong start. We added the position in the beginning of the summer, but and had already quite a good start in the name. We also added Compo Group, which might be a less known company, but they're very crucial for healthcare operators in Germany. Most of their customers are doctor offices, clinics that need software solutions to run their business, to take care of very sensitive client data, to manage bookings, enable digital meetings, and all of this is very crucial for their operations, but it makes out for a very small cost looking at the entire cost base for the doctor's office. And they're, of course, are very well established. They're one of the leaders in this business, and doctors tend to have enough other things to worry about than to changing their software system. So the clients tend to be very sticky in this business, which also is a very attractive characteristics for a business model, we think. And they also traded in a very attractive price range, which enabled us to take this position during the summer. I'll try to be brief here in the interest of time, but it's been enabled us again to travel. So we've been in South Korea recently. We have quite a large exposure to Korea, 15% of the fund. We find extremely cheap companies there based on only steady state free cash flow, near-term free cash flow generation, which is very interesting. And it's of course very useful for us to be able to travel there and to meet management. And the key takeaway is for many of our positions that we're quite impressed with the progress when it comes to capital allocation. So Korea is a very attractive hunting ground for us, and we have high conviction in our positions there.
Yeah, so looking at performance, we have shown you this slide before in terms of the big reset, as we call it. We think there's a start of a new investment cycle at the pandemic low in February, March, which is almost 3 years ago, 2020. And since then, the fund, of course, has a very good run, which has coincided with a more inflationary environment, a more difficult environment, of course, for specific parts of the market that has been in favor for a very long time before this in the QE era, so to speak. And you see that the fund in euro terms has been rising over 100% actually over this period compared to an MSCI ACWI at 60%, and now almost the same developments here for the ACWI value index. So it's almost a very interesting 3-year record soon, which is building here for the fund, and of course we're working hard to keep this up for US unit holders. So just looking at what the biggest and largest contributors, respective detractors, has been in the fund. You'll see that K+S, the potash producer, left the fund in early this year after double, actually. The potash competition disappeared really with the Ukraine-Russian war, where the competition is sitting in Belarus and Ukraine, making K+S a very strong investment, hitting our price target, or more than our price target, actually. So it left our fund. Also, Vale Indonesia, the nickel producer which we had for quite some time, re-rated sharply at this point, also in conjunction with the war outbreak, and also hit our price target and left the fund. Commerzbank, we traded very successfully, was a big position for us heading into the year, very strong in the year. Then we took down the weighting. Now it's very small, but it's been a good performance, still a very interesting name, as if there's a normalization in European. I think this could be a double actually from here in 2 to 3 year time frame. Faurecia has been, you'll see that the companies that has not performed has been associated with a higher leverage, and also a top line that's been challenged. Faurecia is one of those names, the auto parts producer, and also Cascades, the packaging company in Canada, has been hit by the same type of developments. All in euro down about 6% this year in euro terms, the fund.
If you look at the changes since our last update, we have been quite active. We mentioned the new positions that has been added to the fund. We have also increased our positions in US food retailer Albertsons, and also added to our position in French game producer Ubisoft, which we think trade at very attractive levels, especially looking at the midterm cash flow potential, giving this very attractive business. Also, we are not paying for the consolidation option that we get for free in this name, and we think Ubisoft is quite well positioned here from an acquisition perspective, as many of the larger tech players are looking for exposure into this very attractive industry. We have sold our position in Ollis as we hit our price target, also Lincoln National as it hits its duration limit of 3 years, and we have not seen the entire investment case playing out, so we have a rule of thumb there to sell out. And we have also sold out our position in GrafTech, as we find it short on catalyst, and also that the leverage factor is present in that name. Also, as Jonas touched upon before, we have reduced position with exposure to leverage and weakness in top line. So these are auto related names primarily, but also Cascades, and we have been taking profit in Fujitec and San Martino to make space for new positions. Looking at the composition of the fund, I just want to highlight that, as we indicated before, we have broadened the fund. We have 49 positions now, have been taking down the concentration in top 10 a little bit. The fund is quite exposed to small and mid cap, 80% of the fund. But what we want to highlight the most stands out. It's the 70% weighted upside to our price target, which is a very high level, which we haven't seen since the bottom of the pandemic, actually. And it's still a quite fresh portfolio, with 51% of the positions being less than 1 year since inception. And looking at valuation metrics, you can also see that it trades quite attractively compared to any type of index or benchmark, but still good company, strong balance sheet, and high return on equity.
So just to sum up, we think SKAGEN Focus is a unique fund vehicle, contrarian, price-driven, and also with a green transition investment angle, which we had described to you in earlier presentations. And this market we're looking at right now is not all doom and gloom. We see very interesting opportunities for a value price-driven investors like ourselves with a contrarian investment process. In a 2 to 3 year time frame, we see extremely interesting price tags in many sectors, in a broad base of sectors. We have therefore increased our consumer-related names, as we have shown you. Also, technology has been increased in the fund in this correction. And you'll see that, as David mentioned, and importantly, there's a 70% upside to our aggregated price target. We haven't seen that level since the depth of the pandemic. So we think this is a very interesting time to consider the fund, actually. So this is what we had for you today. So I don't know if there's any questions, Ole Christian. Or...
Indeed, there is. Obviously, these are challenging times in so many ways, but one of the viewers is wondering, the focus you have is on individual companies, but how do you deal with the political risk in the portfolios?
Yes, when there's a risk factor which is associated with political factors, we tend to give each stock 3 fundamental risk factors, and that potential political risk, if that's something that we think is a top 3 risk in that investment case, will be added to that list and then aggregated across the portfolio. So we think when it's a relevant risk factor, it shows up in our risk systems, and we don't want to be overly systematically exposed to any geography or political risk type of situation. We can have a few, of course, especially if it's already built into the equities valuation, but we don't want to be too systematically biased to any of those geographies, basically.